Most of us were taught two things about money growing up. Money is something you earn by working hard, and money is something the government prints whenever it needs more. Neither of those ideas is actually true, and the gap between what you were taught and how the system actually works is exactly why so many hard-working people feel like they are falling behind no matter how much effort they put in. What you're about to hear is a part of the financial system that many people never learn in school, so it often feels confusing. Once you understand it, you will never look at your paycheck, your rent, or your grocery bill the same way again. Stay with me through this whole video, because the further we go, the more it will click into place, and the ending will change how you make decisions with every dollar you touch from here on. Where new money actually comes from. Physical cash, the bills and coins you can hold in your hand, makes up only a small slice of all the money that actually exists in the economy. The overwhelming majority of money is not paper at all. It exists purely as numbers inside a computer system, and here is the part that surprises almost everyone the first time they hear it. Those numbers are not moved from one place to another when a loan is issued. They are created from nothing at the exact moment someone borrows. Picture a buyer who wants to purchase a home and needs a $300,000 mortgage. The bank does not open a vault and hand over stacks of bills that other customers deposited last year. Instead, the bank simply enters two lines into its system. The buyer now owes $300,000, and the seller now has $300,000 sitting in an account. In that single instant, 300,000 brand new dollars entered the economy that did not exist 5 minutes earlier. Lending does not simply move existing money from savers to borrowers. In modern banking systems, commercial bank lending can create new deposit money, which increases the money supply. If that sounds hard to believe, keep watching, because this one idea explains almost everything else you are about to learn. The price of everything and why it keeps climbing. This is one important reason prices can rise over time. Although inflation is influenced by several factors, and this mechanism plays a meaningful role decade after decade, no matter which generation you ask. Every mortgage signed, every car loan approved, every credit card balance carried into next month adds a new batch of dollars into circulation. More dollars competing for the same number of homes, cars, and groceries means each individual dollar buys a little less than it did before. A meal that cost a few dollars decades ago now costs several times as much, not because the ingredients became harder to grow, but because there are simply more dollars chasing the same plate of food. This is a big part of why an earlier generation could buy a home on a single average income, while that same math feels nearly impossible today. It was never really about houses becoming impossibly expensive on their own. It was about how many new dollars kept entering the system every single year, quietly diluting the ones already in your pocket. Now, here is where it gets even more interesting, so do not tap away just yet. The cantillon effect and why. Distance from money matters. If new money keeps entering the economy every year, why does it not make everyone equally wealthy at the same pace? Why do some people seem to get richer effortlessly while others feel like they are sprinting just to stay in place? The answer actually has a name, and once you understand it, the entire wealth gap starts to make a lot more sense. Economists call this the cantillon effect. New money does not appear equally in every bank account at the same moment. It enters the economy at one specific point, usually through large financial institutions, and then it spreads outward from there the same way ripples move outward from a stone dropped into still water. Whoever stands closest to where that stone lands feels the benefit first and feels it the strongest. Whoever stands furthest from that point, which for most of us means the average worker earning a regular paycheck, feels the effects last, and usually only after prices have already climbed around them. Picture this playing out step by step so you can see exactly how the timing works. A large investment firm gets access to a loan at an unusually low interest rate simply because of its size and its relationships with major lenders. With that borrowed money, still cheap and still early in the cycle, the firm buys up real estate while prices in that market are still low. Months later, as more of that new money spreads outward through banks, businesses, and households, more buyers enter the same market with more cash in hand, and demand for that limited supply of housing pushes prices sharply higher. The firm that bought early now watches the value of its properties double without lifting a finger, simply because it was standing closest to the source when the ripple began. Meanwhile, the contractors hired to renovate those properties and the suppliers who deliver materials to the job site earn a modest profit, passed down from all that spending. They are a step further from the source, so they only catch a smaller piece of the wave as it moves past them. If you are still with me, you are about to see exactly where you fit into this chain, and it might surprise you more than you expect. Now follow the money one final step, all the way down to the average employee. By the time a company's profits are large enough to justify raises and year-end bonuses, an entire year or more may have already passed since that new money first entered the system through the initial round of lending. Your wage might go up by a modest percentage, and on paper, that certainly feels like progress. But during that same stretch of time, rent, groceries, and everyday expenses have often climbed even faster, because prices adjust to new money much sooner than wages ever do. So your income rises on paper, yet what you can actually afford stays flat, or in many cases, quietly shrinks. This has nothing to do with failing to work hard enough or failing to negotiate well enough at your job. It comes down entirely to position. Wages sit at the very end of the line, the furthest possible point from where new money first enters the economy. Large businesses and asset holders sit near the front of that same line. Everyday workers, through no fault of their own, are almost always positioned near the back. Here's why this cycle repeats itself generation after generation instead of correcting itself. Most people respond to rising prices by working more hours or picking up a second job, which brings in little more cash but does absolutely nothing to change their position in the line. They are still standing at the back of the ripple, just running a bit faster to keep from falling further behind. A smaller number of people, once they understand how the sequence actually works, shift their focus away from simply earning more currency and toward holding things that move in the same direction as the money supply itself. That single shift in thinking is the real dividing line between the two groups, far more than luck, more than raw income, and more than which family someone happened to be born into. Here is the part that actually matters for your own life, starting today. You cannot control how the system creates new dollars, and you cannot control who gets access to the cheapest loans first. That part of the game is largely out of your hands, and no amount of frustration will change it. But once you understand the sequence, you can stop being blindsided by it and start planning around it instead. It means recognizing that cash sitting completely idle for years is not actually safe, since sitting at the very back of the line means you absorb every price increase with no offsetting gain whatsoever. It means paying closer attention to owning things that tend to rise in value alongside the money supply, rather than only holding on to the currency itself and hoping it keeps its worth. It means understanding that a rising number on your pay stub is not automatically the same thing as rising purchasing power, and building your financial decisions around that distinction rather than being reassured by a number that does not tell the full story. None of this requires insider access, a finance degree, or a lucky break. It simply requires understanding the sequence you just learned and making the decision not to remain the last stop on the line forever simply because nobody ever bothered to explain how the water actually flows. Now that you know exactly where the ripple starts and exactly where it ends, the only real question left is which side of that ripple you plan to stand on from this point forward. If this video changed the way you think about your paycheck, sit with that feeling for a second, because most people go their entire lives without ever hearing this explained in plain language. Schools teach you how to balance a checkbook. Far fewer teach you how the checkbook itself loses value every single year through a process most people never even notice happening. This topic simply is not covered in depth in most school curricula, which leaves many people learning about it much later in life, and closing that gap for yourself is one of the most valuable things you can do for your own future. You do not need to become an economist to benefit from this. You simply need to remember one thing every time you get paid, every time you see a headline about interest rates, and every time you wonder why your money never seems to stretch as far as it used to. Position matters more than effort alone ever will inside a system built this way.